What is going on, guys? Jack from JR Options here, and today we are going to be going over my favorite strategy, the debit spread. So, what a debit spread is a risk-defined option strategy where right when you enter the trade, you know what your max loss and max profit will be. So, in order to make sure that we can actually trade these spreads, we are going to want to make sure that we are on level 3 options. So what that means is if you go into account and then go to settings, we'll be able to see our level of options under options trading. So make sure that it is on level 3. If it is not level 3, you're going to want to upgrade to level 3 so that you are able to do these spread strategies. Now, after you've done that, let's head over back to our charts and use our example of Amazon. So what a debit spread is essentially buying a option contract and then selling a farther out of the money options contract in order to create what is called a spread. So in order to do this, we are going to get a 1 month out spread. So in order to do this, click on the expiration date right over here, and we're going to go to 4 weeks out. So that is going to be the January 29th contract. So with a debit spread, it is going to be, and this is a call debit spread. So this is going to be a bullish position, meaning we think the stock is going to go up. And all that really needs to happen here is it is going to have to go up above where we think it is going to go by January 29th. So let's see how we're going to actually make this spread. So Amazon has been on a tear recently, and it is basically breaking out of its bullish pennant, meaning I think Amazon is going to go a lot higher than where it is right now. So what I believe is going to happen is Amazon by January 29th is going to go above $3,300. So in order to open this, I'm going to buy the 3,300 call. So in order to do that, you're just going to click on the plus. And if you are on the Robinhood app, you're going to want to click select in the top right corner of the option chain. And then after we purchase the 3,300 call, we are going to be selling the 3,305 call. So once again, that is buy. We're going to go to sell and then sell the 3,305 call. Now, I know how difficult it can be with options trading with a small account where you can't really buy all these big tickers such as Amazon, Tesla, Nvidia, Shopify, and all those big names because let's say you have an account under $2,000, you can't really buy a contract that's 4 weeks out or at the money or even close out of the money because it's going to cost, similar to this $3,300 call, it's going to cost $10,000 for one of them. And if, let's say, by January 29th, this does not go in the money, we are going to be losing all of it. So no one wants to lose $10,600 on one contract. So that's why I like to do the debit spread. So after we buy the 3,300 call and sell the 3,305 call, this is going to come up with the call debit spread. And you know you've done it right when right over here it says call debit spread. So the reason why I love debit spread so much is because it is risk defined. And all that is going to mean is that you know what your max profit and max loss is right away. So when you're buying a naked call, meaning there is no call that is being sold against it, there is going to be no max profit. And a lot of people like that because you can have insane returns, such as some people with Tesla having thousands and thousands of percent return. But I'm personally not really a fan because you don't always know when to take profit and you actually end up losing on the trade. So with this, our max profit is going to be the difference between the strikes minus the total cost that is paid. So here we bought the 3,300 call and we sold the 3,305 call. So that is going to be a difference of $5. Now, as you can see here, the total cost is going to be $2. So all that is since we bought the $3,300 call contract expiring January 29th, we are going to be paying $106.18 of premium. And since we sold the 3305 call contract, we are going to be receiving $104.18 of premium. So when you subtract 104.18 from 106.18, that is where we are going to get our $2 of premium. And since it is multiplied by 100, because each contract holds 100 shares, that is going to cost us $200. So basically what's happening with a debit spread is, since you're buying the $3,300 call contract, that is going to be giving us the ability to purchase 100 shares of Amazon at $3,300. And since we sold the 3305 call contract, and since a call contract gives the buyer the right to buy 100 shares at the strike price, we are going to be obligated to sell 100 shares at the strike price if it expires in the money. So since we bought the $3,300 contract, and if it expires in the money, we're going to be purchasing 100 shares at $3,300. And if it is above 3305, we're going to be selling 100 shares at 3305. So let's look at actually how to execute this trade. What you're going to want to do is, after you have it all set up, you're going to click continue. And then where it says contracts, you're going to put 1 so that you make sure you are opening up one contract. And since a lot of times there is a big difference between the bid and the ask, you are going to want to put a limit price on this contract. So when I like to execute my debit spreads, I always tend to go for the middle of the bid and the ask. So let's say the bid is 1.5 and the ask is 2.5. I'll always try and go for the middle, so $2 of premium. Now, where it says expires good for day and good till canceled, all that means is, with good for day, if it does not execute within the day, this trade will cancel and it will not execute on a following trading day. So I always keep it as good till canceled, so that, let's say it doesn't execute on the day that I want to execute. If Amazon, let's say, opens down a little bit and this trade, this call debit spread that we are opening will most likely get executed the following day without me having to do anything. So let's click on review order. And here it will show us our max cost. So our max cost is going to be $200. And that max cost is going to be the max loss that we will have on this trade. So unlike a credit spread where the max loss is the difference between the strikes minus what we receive in premium, our max loss is just going to be the $200, which is our total price that we are paying. So you'll know if you've done this right if it says call debit spread up here. If it says call credit spread, you have done something wrong, and that means that you've sold the closer to the money strike. So definitely you don't want to be doing that, as that will give you a completely different type of trade that we will go over in a different video, so be on the lookout for that. Okay, so let's take a look at another example. And by the way, the max profit, since the max loss is $2, is the difference between the strikes minus what you are paying, which would be $5 minus $2, which is $3 times 100, which is $300. So let's talk about time decay and how that will affect these debit spreads. So as we know, with time decay, on this, let's go for this $3,300 contract. The implied volatility is 34.29, and theta is 2.16. So what that means is, for every single day that passes going closer to expiration, our contract will lose $2.16 of premium. Now, since if we were to buy this contract naked, meaning we're just straight up buying this $3,300 call, we would be losing a ton of money just on time decay. Now, the reason why I love debit spread so much is because it will protect you against time decay. So since you are buying the 3,300 and selling the 3,305, the theta is pretty much the same. So theta here is 2.16, where theta on the 3,300 is also 2.1633, where the other is 2.1622. So that basically makes theta negligible in the short term, as no matter if Amazon were to go up, we would be making money, and if Amazon just goes down, we'd be losing money, and we wouldn't be losing additional money on theta. Now, as we get closer to our expiration, which is the January 29th, theta is going to increase. And our closer contract, the one that is closer to the money, the 3,300, that is going to be losing more money as time gets closer to expiration than our 3,305. So let's say we are 1 week up until expiration. Our time decay is going to be hurting our contracts rather than helping us, unless we are in the money. And that is a completely separate thing, which we will be going over in our credit spread video. So since theta is hurting us, that is one thing that we want to be aware of. And the farther out of the money we go, the more theta is going to hurt us in the long run, because it's going to be harder for it to get to that strike price. So as long as it is out of the money, theta is going to be hurting us. Okay, so now let's go over and look at delta. So the reason why the debit spreads will increase in value is because our closer, as Amazon were to go up as we expect, since this is a bullish position, is as Amazon goes up, the delta on the closer contract is going to be 0.46, roughly 0.466, where the delta on the 3,305 contract, which we are selling, is going to be 0.46. So that is roughly a difference of, we'll round to 0.01, so 1 cent per dollar. That means, because delta is the rate of change per $1 increase. So as delta increases, because Amazon is going up and delta is helping our contracts, our entire spread is going to increase in value as Amazon goes up. So now let's talk quickly about implied volatility. So with implied volatility, that is also going to help our spreads, assuming implied volatility goes up. So implied volatility tends to go up in times like earnings, with a run up to earnings, a lot of news events, or just a technical breakout where there is a big change in movement that is above the expected implied volatility. Now, with an increase in implied volatility, that is going to help our 3,300 call that we are buying more than the $3,300 call that we are selling. So due to that, that is going to help our debit spread and allow us to get more tendies. So now that we've gone over how the Greeks affect our debit spread, let's look at an example of how we would actually close our spread. So here we have the Amazon debit spread that I opened last week. And since it's saying Amazon 3245/3250, all that means is that we bought the 3245 and we sold the 3250. So let's look at the 1 week difference in the price movement on this debit spread compared to the actual Amazon movement. So as you can see here, in the beginning of the week, the spread was worth 1.55, so $1.55, and then it hit a high of $3.78. So when I purchased this contract, I purchased it for $1.70, so right about here. And then Amazon broke out. It went from roughly $31.50 all the way up to $3,300. So when I bought it for $1.70, and Amazon increased in price, my debit spread also increased in price all the way up to $3.75. So what happened there is I was up a total of $2 per spread. So since I bought it for $1.70 and now it was at, we'll go roughly $3.70 to make it sound better. That would be an increase of $2 per contract. And since I bought it for $1.70, that was a profit of $200 since it's $100 per, since it's 100 shares per contract. That gave us a return of 117%. So let's say I wanted to actually sell this contract at that area. So right now, later in the week on Thursday and Friday, Amazon decreased in value, and this brought our contracts from roughly a high of $3.80 all the way back down to $2.25. So overall, the total return is still $55 or 32.35%, which is still very good considering the massive fluctuation that Amazon has had. So in order for me to actually hit max profit, since this expires this week, theta is going to be hurting me as long as it is below 32.45. So we want this to be above 32.50. So let's talk about closing this contract. So what we can do is let it expire. So what happens at expiration is if it fully expires in the money, we are going to be hitting max profit because we are going to be buying 100 shares at 32.45 and selling 100 shares at 32.50. That is a $5 difference, which would mean that the entire spread is going to be worth $500. And since we bought this spread for $1.70, our max profit is going to be $330. Let's talk about closing this contract early if we don't want to let it expire in the money. So what we can do is all we have to do is open our trade, and then we're going to go to close. You see how on this area there is an option to open the spread if we want to, let's say, average down, since I think Amazon's going to be going up again this week, so I can open up another one of these spreads, or I can go to close. And what I'm going to want to do is I'm going to want to go to $1, one contract, and then we're going to want to set a limit price that I want to be letting this get sold for. So I would be trying to go towards the ask. So here it shows that the limit, the bid is going to be on the left, so that's $0.00, where the ask is $5.20. That is just because of the massive spread on these, the bid and ask of the actual contracts that we have. So Robinhood recommends 2.25. That is what I will go for. And all we're going to want to do is I'm going to go to good till canceled, so that if this doesn't execute on the original day that I open this close order, it will most likely go through as long as Amazon keeps rising up on the following day. So you're going to see here it says minimum credit. So this is different from opening it, because when we open it, it's going to say max cost, or on some other brokers, you might see debit. And debit, you're going to remember that as what you're paying, and credit is going to be what you are receiving. Since it says max credit, that is going to be what we are going to be receiving. So we're going to be selling this for $225, and we're going to hit receive order, and it's going to say credit or debit. So this is just another layer of protection to make sure that you are doing exactly what you want. And once again, if we are going to be selling this, we're going to hit credit, and if we're going to be buying it, we're going to hit debit. So since we have one available, we're going to hit credit. Okay, and here it's going to be showing us the order summary. So since with the initial contracts that we bought the 32.45 call, so we're going to want to do the opposite of this and sell to close the 32.45 call. And then on the opposite end, since we sold the 32.50 call, since it is farther out of the money, we are going to want to buy that back. So we're going to buy to close this contract. That is pretty much going to be the basics of the call debit spread. Next video, we're going to be going over the put credit spread. So that's another bullish position. So be on the lookout for that. If you guys want to help support the channel, make sure to smash that like button and drop a sub for more content like this. Also, make sure to comment anything you guys want me to clarify, and I'll be responding to as many as I can. All right, I will be seeing you guys in the next one.